Hello, and thank you for joining our webinar on common misconceptions in early-stage corporate debt financing. I'm Shane Fearman, Director of Marketing at Capital Advisors Group, and I will be your host today. Covering today's topics are Stefan Spacek, Executive Vice President, Director of Debt Placement. A little background on Stefan. Stefan Spacek joined Capital Advisors Group in 2006 and currently oversees the company's debt consulting business nationally. He also supervises business development in the New England and Central regions. Now, before we get started, there are a few housekeeping items I would like to cover. You'll notice an area within the module on your screen where you may submit questions at any time during the course of the webinar. Stefan will review these questions and will answer them during the Q&A at the end of the webinar. We will also be sending out an email after the webinar with a link to the presentation and contact information for Stefan. I'll now hand the presentation over to Stefan. Stefan, take it away.
Thanks very much for the intro, Shane, and thanks to all of you on the line for joining us today for common misconceptions in early-stage debt financing. Just a quick broad definition of how we define early-stage debt financing. It's basically any company, regardless of how long the company's been around, any company that would kind of be earlier in that sort of venture or growth stage, really before a company has, significant revenues and profitability and would be able to go to a local, regional, or large national bank and get a loan or line of credit. We're working with a subset of capital sources that are kind of earlier on, kind of prior to that very large commercial banking lending type structure. So we're going to take about 30 minutes for the presentation today. Hopefully about 20 minutes on our end, and then send it to Q&A. So we'll give a little high-level overview on Capital Advisors Group and what we do, and then we'll broadly talk about the when, the why, and the how much when it comes to debt financing and how to answer those questions. And then some misconceptions in there that, we, in talking to companies across the country, commonly run into from time to time in terms of what companies are thinking about when it comes to debt financing, that might not necessarily hold true in the market. And then I'll take us through a brief step-by-step case on a client of ours that really hit the nail on the head on the when, why, and how much, and brought themselves to a terrific outcome by using debt financing, and then just talk a little bit about sort of the structure and the process of an actual transaction a little bit. So getting into about us, Capital Advisors Group, the firm itself has been around for about 28 years, is a registered investment advisor. We've been advising companies on debt financing transactions for probably 16 years now, since 2003. And since then, we've advised hundreds of companies, nearing about 500 companies on about $2.5 billion more in debt financing transactions. We have a library of term sheets that is well over 1,000 now, and what that does is provides a historical perspective on terms and conditions that helps us track, obviously, the history of the market, but also keeps us well apprised of current conditions in the market. And then gives us a sense of trends and where things are heading in the future. Obviously, we're in the market on a daily basis. We're fairly sector agnostic. There's some logos on this slide that kind of show across healthcare, technology. We also work in sort of the sustainability area when it comes to agricultural technology or bioagriculture. We've done deals in that area as well. And we have nearly 200 sources of capital that we can tap into, given who we're working with, what sector our clients are in, and the size and structure of the transaction that they're pursuing. So when it comes to why would companies pursue debt, it varies widely, but obviously the primary reason here is that debt financing is pretty much always less dilutive to founders and management and shareholders than is equity. And so debt is often used as a complementary component to equity, or if the company has revenue or is profitable, It's a less dilutive method of financing, although it comes with the caveat of having to pay it back and some other fees and conditions. But it's obviously financing that would be less dilutive than the equity. You know, understanding the debt markets and who the players are out there is obviously kind of what we consider the benefit of our presence in the market and helping advise companies on these types of transactions. So jumping right into when a company might consider debt financing. So there's no easy answer to this question. It's probably the hardest question to answer because it's very specific to every company and every deal that we're involved in. There's a few steps that companies should take, though, when they are even thinking about it. First, identify, you know, how will debt be used strategically to the advantage of the company? How will it get the company from where it is to reach a milestone or goal that it otherwise wouldn't be able to without this type of financing? And then how much would it take to get there? What's that number? Because, you know, as I'll touch upon a little later, maximum leverage isn't always the best approach when it does come to debt financing. And then how is it going to be used? Is it kind of near term, trying to grow sales and marketing or boost manufacturing or some other reason? Or is it really looking out longer term? If a company's burning cash, is it going to extend the cash runway to help a company achieve one of those goals or milestones that otherwise wouldn't be able to? Because those are two very different you know, purposes or uses of the financing, and may change sort of the size, the scope, the structure of the transaction based on the use of proceeds. And then really a big part of identifying if a company is even going to be suitable to pursue this type of financing is sort of taking a look from the outside in and really trying to understand from a credit perspective if the company does present a quality credit to the lending community. So depending on what phase the company's in, is it early, is it in growth phase, is it commercial and profitable, that certainly will help determine the appropriate sources of capital in many cases. If the company's burning cash, does it have at least 12 months of cash remaining? That is a primary concern for lenders as they think about viewing these companies, and from a credit and underwriting perspective, they want to see at least a year of cash if the company's burning cash. And then who are the current investors? Are they larger institutional investors? Are they strategic investors? Are they friends and family? Are they family offices? This is an important consideration because lenders do view and value different types of investors in different ways. Obviously, the largest institutional investors and VCs or private equity funds with deep pockets are sort of most favorably looked upon, and then it kind of goes down the list from there. How much equity has been invested in the company already? Is it a $3 million A round, or is it multiple rounds and you know, $100+ million? Obviously, an underwriting consideration from the lender's perspective there is, you know, investors are much less likely to, you know, lose an investment that's greater than a smaller one. So. And then on the healthcare side, we run into issues like near-term regulatory risk. Is there data coming out? Is there clinical trial results that are coming out that could affect the company one way or another? And if there is data coming back, then is there a deep enough pipeline of assets for a healthcare company that can support the company? You know, if a lead asset fails or gets negative data. So those are considerations there. Issues with intellectual property, we run into this all the time. You know, is IP in licensed from another institution? Does IP reside with the company, or is it in a shell company overseas? We've seen that as well. Intellectual property in many cases in early stage financing is the greatest asset that these companies have. So that's certainly a primary consideration. And then when there is revenue, or is the company demonstrating positive year-over-year growth? Is it showing low customer churn? Are there high margins on the product or service that are being offered? Those are all considerations. You know, obviously, anyone making an investment, whether equity or debt, in any company, want to see quality performance numbers over time. So moving on, so timing is certainly a consideration when it comes to the when of debt financing. So oftentimes, if a company has recently raised equity and it's burning cash, I've got an example here of when it might be too early. So this top ramp, it's basically the bottom blue color shows the equity that's been raised. Call it $40 million. It's going to last this particular company in this example 27 months. However, based on the structure of debt financing, and in this example, it would raise another $15 million on top of the 40. Because of the structure of debt financing, there tends to be an interest-only period before it begins to amortize, and then there's some other fees associated with it. In this example, the amortization period really kicks in well before the company is going to be able to take advantage of the debt financing in a runway extension. So the amortization sort of eats up that runway extension as it gets out to the end of the term and only gets a couple of months of runway extension. We really think the optimal time for runway extension for cash burning companies is in that 12 to 18 month time frame. We also often see cases where a company might raise equity from a large, well-regarded institutional investor, and then the banks really kind of jump all over themselves to try to provide a line of credit or some sort of loan very early on in the process. And sometimes the company may not even realize the benefit of what debt financing could offer them at that point, but they take it because it feels like there's an offer for extra money. And I mean, in reality, what that does is, the bank kind of locks up the company's all the banking services on as a condition of that loan. So it's sort of a formula for the banks to offer up these loans. But oftentimes, what we've seen later on is that it really kind of creates a cash crunch when the company wants more flexibility on cash. Then the banks sort of require that there's an over-collateralization of the outstanding loan, and there's a certain portion of cash that a lot of companies can't even touch. It has to remain in the bank as collateral for the loan. And so sometimes if it's too early and there's no real sense of how the debt's going to help the company, it might not make sense at that point to pursue debt financing. And then if the runway is too short, as I said earlier on, that 12 months of cash requirement, and again, these are for straight cash burning companies, debt is never a life preserver. The mantra for lenders and debt financing is that we don't want to be last money in. They're looking to, over the term of a loan, which might last from 3 to 5 years, sometimes more, they want to make sure that the company is going to be viable over that period of time. But they don't want to be, the last money that goes into that company, unless, again, it's demonstrating, high growth, high revenue, and really leading toward profitability. That is an example of when it might make sense. But again, I'm just showing an example of a cash burning company. Any high growth company that's tracking toward profitability is not just a straight cash burning company, obviously. So there are other conditions around when it can make sense if a company has a shorter cash life. And then looking at why to pursue debt financing, well, there's a host of reasons. I mean, pretty much an endless list of reasons. I can say on the deals that Capital Advisors Group is working on now, there are no two companies that are pursuing debt financing for the same reason. And our current deals, one is to accelerate a pipeline of assets for a healthcare company. Another one is for sales and marketing expansion. We're doing another one to set up manufacturing capabilities. So there's a term loan and an equipment portion there that we're helping on that transaction. A low-cost bridge to profitability, helping another company in that regard. Acquisition finance is another reason that's not listed on this slide, but another transaction that we're advising a company on in that regard. And then, oftentimes companies are looking to refinance loans that have been kind of outstanding for some time. They've paid it down for the most part, but they want to refinance it and get some new flexibility on that cash and probably at a lower cost of capital. So those are all deals that we're working on now, and all sorts of different reasons that it would make sense to pursue debt financing. The one thing that I hate to hear is, well, we just want to bolster the balance sheet, or we just raised some equity, so we want to tack on some debt. That immediately raises red flags for me. I feel like the company's just taking on cash because it can, without a real clear focus on the strategic benefit of debt financing. I always want to try to understand what is the use of proceeds, how is it going to help the company get to where it otherwise wouldn't be able to. That's key, because the second you take that loan, you have to start paying it back. So we want to really understand how it's going to help companies before they execute a transaction. And now getting into the quick case study here, this was a really interesting engagement that we had not too long ago, where we knew the investor well. It was a large institutional investor, and the company came to us really at a very early stage. It was kind of pre-Series A. And they said to us, okay, this is a timeline of what we're trying to achieve, and this is going to be our general burn rate, and how much money we're going to spend. And we need to hit these clinical milestones in order to negotiate an acquisition from a large pharma partner. And so basically we went to the company and said, and they asked us, what sort of combination of equity and debt is it going to take to get there and to successfully do that? And so we kind of were able to structure, put together their entire capital structure and make recommendations in that regard, and show them a few different examples. And a very general benchmark for cash burning companies when it comes to leverage is that if a company has raised equity, through private equity or through public markets, a very general benchmark, obviously there's a lot of conditions here that can change this, but a company might be able to raise up to 50% of the cash on hand. That's sort of the level of comfort for most lenders. Again, that's a broad benchmark. But when it comes to revenue, if there's annual recurring revenue, monthly recurring revenue, or other structures, that include royalty payments or revenue finance, when revenue is involved, and profitability is involved, there's also EBITDA-based transactions that are structured that way. So there's all sorts of different structures when there's revenue and profitability involved that we can get into, and that really changed the calculus on leverage and what could be available to a company. But in this case study, so we provided a few different examples. One was a couple of different tranches, where they would take on, about 11 million and then tack on additional debt on top of that. And again, the leverage number here is a little higher, but that was really based on the institutional investor. And again, a deep-pocketed investor that was willing to do whatever to carry the company forward. And then a second tranche down the road, which would give them kind of a window into the timing of those clinical milestones and how things were proceeding. This was one option we provided. A second one was basically raise it all up front and then kind of hope for the best. But we sort of knew that a tranched structure would probably be most beneficial to the company as they were trying to, hit certain milestones on a timeline, that a second tranche would make more sense for them. And that's what they ultimately pursued, was the two tranche structure. And, so it was a perfect scenario from the when, why, and how much. The large pharma partner, had predetermined buyout terms based on these clinical milestones, so the company knew how much it would take to get to where they needed to go. The investors were really willing to invest what it took to get the company to where it was, and they wanted to put in minimal capital for maximum ROI. So, they knew that the when meant early on in the company's life cycle, because they just had to hit a couple of early milestones to get to that ROI. And then, why was that? Again, they wanted to make a minimal investment. The investors had an operating partner as the CEO, so they were very well aligned, and we had those clear timelines to get to the milestones. And ultimately, the company very successfully hit its milestones. It was a competitive process, which is what we do. We bring in multiple lenders to compete for our clients' transaction, And so, no covenants, no prepayment penalties, low cost of capital, really great structure for the company. They executed tremendously well, hit their timelines, achieved their objectives, and they were acquired for nearly $300 million about 18 months later. So that's a really great example, although rare, of perfect timing, perfect use of funds, and a fantastic outcome. And so when it comes to the debt process, this is really our process. This is what we do. We come in early on. We consult with a company. We help them understand, what could make sense, and if debt would be a viable financing option. Then we prepare the deal, kind of prepare an RFP. We collect all the financial information, investor deck, everything else that we know the lenders are going to need to review the transaction and understand if they want to pursue it and submit terms. We bring in the most appropriate lenders for every transaction. Again, we have almost 200 sources of capital, and it really covers the gamut of senior and subordinated loans, cash flow types of structures, or cash burning structures, term loans, lines of credit. So it really goes across the board in terms of what would benefit our clients most. So we bring in the most appropriate sources of capital, and then we negotiate, hopefully collect multiple term sheets, and then work to kind of line those up and negotiate those based on our client's priorities in the transaction. That typically takes 6 to 8 weeks as a timeline. So good to consider that timing when you do think about pursuing a transaction. 6 to 8 weeks to negotiate the final terms, and then probably as you go through, then after that it goes to final due diligence and documentation, which could take another few weeks. So you consider a full transaction lasting about a few months. So considering optimal timing and when to do it, you want to kind of add that buffer in as well. So that runs through the presentation portion. So I'm happy to jump to Q&A.
Excellent. Thank you, Stefan. So thank you. So we'll move right into the Q&A session. So if you haven't done so already and you have questions, again, there is a module located in the GoToWebinar section of your screen. It could be on the right or the top of the screen, depending on how you have it. You can feel free to submit any questions there. We'll try to get to them now. We have a few already, and anything we can't get to, we'll have Stefan follow up with you directly. So let me just pull these up here. So first question. How do prerequisites for raising venture debt vary by industry?
So how do prerequisites vary by industry? I would say they probably don't vary by industry. They really vary by the financial conditions of the company. So I talk a lot here about cash burning companies and companies with revenue and profitability. That's where the prerequisites kind of come in there. Who are the investors? How much cash has the company raised? If there is revenue, is it showing, significant growth, quarter over quarter, year over year, good margins, so all of those are sort of prerequisites when it comes to the credit consideration that the lenders would have when they're reviewing a transaction. So again, cash burning versus revenue producing, that's really kind of where how the prerequisites do come into play, not really by industry, I would say.
Great, thank you. Next question. Do you see a cap in leverage past which venture debt is unadvisable?
A cap in leverage. So I did explain kind of the leverage benchmark for cash burning companies was sort of 50% of cash on hand if the company had 12 months of cash. So in that kind of scenario, if 1-to-1 leverage without revenue is probably difficult to impossible to achieve unless there's some outside influences or conditions that would make that available. But that benchmark obviously doesn't hold true, as I said, for companies that are growing, producing revenue, that are heading toward or are profitable. In those cases, it really varies depending on what the company's needs are. and so it's hard to say exactly what a cap would look like. However, we definitely know when a company is seeking too much leverage, and we can look at their financials and understand that that's the case. And that's really based, we're looking at a lot of different aspects within their, their cash flow statement and their balance sheet to really understand what leverage should look like for the company.
Excellent. Okay, we have 2 more questions here. How have you seen deal terms change over time, and what are some main drivers for these changes?
The easy answer to that question is that yes, we have seen terms and conditions change quite dramatically just over the past 10 years, and the bottom line there is competition. There are far more lenders in this space than there were 10 years ago, and it's driven some incredible competition. It's certainly benefited borrowers in this environment, but again, we're looking at so many different types of structures across the spectrum of companies that we're working with. All I can say is that broadly, conditions have changed for the better to borrowers.
All right, one more question here. Will debt financing make it harder to raise equity in the future? What are some do's and don'ts?
So I get this question a lot, and I think the quick answer there is no. We have no evidence that debt financing makes future equity rounds problematic. Although it's hard to look into private companies and understand if they've faced issues there. And in our experience, they haven't, and that's just really talking to companies on an individual basis. We have done research projects in the past for public companies where, basically when we've run transactions for public companies, it's we've looked at their share price prior to the announcement of a transaction, prior to that closing, and then we track the share price after the fact. Obviously there's outside influences that will move share price, but we've never seen a share price that significantly impacted any time shortly after announcing a debt financing transaction. I think in the earlier stage space, it's ubiquitous. There's lots of debt financing going on out there, and I think investors and other folks know that that's sort of part of the industry and sort of a norm of how these companies are taking on financing and funding growth.
Great, thanks, Stefan. All right, so that concludes our webinar for today. Thank you all for joining us. We'll be sending you an email with a link to the presentation as a follow-up, along with Stefan's contact information. If you do have any questions, feel free to send them to us now, or you can send them to Stefan once you have his information. And we will be letting you know when we have more sessions coming up in the near future. Thank you again, and have a great day.
Thank you.